to a really great financial future. Tom and Don are talking real money.
Talking Real Money continues with another really thrilling episode about a topic that hasn't been covered on Talking Real Money in a very, 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 very long time. We try to cover these kinds of things, these important areas of investing that you should have in your portfolio. But, there's so much stuff. We can't cover it all the time, and new people are coming on. So we were reminded of this to speak about this because of the passing of a proponent of this type of investing, the magnificent Mark Mobius.
Which is a name that if you've only been an investor for 20 years, you will not know that name. Unlikely. If you're most people,
30 years. If you're most people,
all right, fair enough.
If you're 95% of the population of the earth,
okay.
No, 99% of the population of the earth, you have no clue who that is. If you're Tom Cock, of course you do.
Yeah, because I've been around for a long time. So.
Plus, he likes really obscure information.
Well, that's true too. Mark was a guy that studied, was a PhD. I mean, he didn't just stumble onto the investment business.
He wasn't just a guy.
Yeah, he was. And his whole shtick, if you will, was telling people why they need to invest in emerging markets. Now, oftentimes when I talk to people about investing in emerging markets, it's a tough sell. They think, wait, those are kind of like China, India, Brazil. It used to be Russia. We don't invest there anymore. Places in the Far East. Is there
anything left to invest in Russia?
Good question. I just heard a joke about Russia, but I'm not going to re-say it. Anyway, the point is, Mark spent his career doing that. He was. Is this unkind? Because he had a shaved head, his nickname was Bald Eagle. I don't know how to take that.
They also called him the Indiana Jones of emerging markets.
I saw that, yeah. Or someone else said, Mark Mobius is to emerging market investing what Colonel Sanders is to fried chicken. Not sure if that's good or bad anyway.
Given the fact that most people never think about emerging markets investing, that's why you don't know who this man was.
Yeah, and he joined Franklin Templeton, again, a company today that would be, unless you've been around for 30 plus years, you probably don't know them. Joined in 1987 and directed people towards international opportunities. Over his tenure, he managed the group's closed-end fund, the Templeton Emerging Markets Investment Trust, which they say returned an average of 13.4% a year from 1989 until his retirement. Beating the index, and it's always about beating the index, right? But it doesn't talk about how much risk you took. Anyway, that's all fine. Here's the reason that I wanted to discuss this. And by the way, he went to these places and looked at these companies, 250 to 300 days a year, visiting factories, local distributors, and you know what Dr. Fama and Dr. French are going to say? They're going to say that it's meaningless. Yeah, they're going to say, but that's fine. And he told people, look, you really need to invest in these places and have some of your money exposed to emerging markets. Now, we're going to agree with him there. No question. I think you should. I looked it up. According to a couple of different places, the average investor has about 3% of their money exposed to emerging markets, right? These riskier, developing, sometimes is the word they use, countries. And I just had a great chat with someone yesterday asking about, well, can't you just get exposure to those if you own companies like Microsoft because they sell products there? And the answer to that has been, and this is not from us, this is from Dimensional Funds that did the work around this, no, that you need to be exposed to those local economies and those local currencies to really get the potential growth. And that's the bottom line about why you want to have some of your money exposed to emerging markets. I would say if you're doing a full 100% of your money's in stocks, I'd think somewhere around 10% of your money should be in emerging markets because that's about what it makes up in the global world in terms of the value of firms.
Yeah, and if you had invested in emerging markets in the Dimensional Emerging Markets Fund 30 years ago, back in 1996, beginning of 1996, let's go back to 1995, you would today have 10 times the money you invested. $10,000 invested then would be worth almost $100,000 today over 30 years.
Well, I can give you better than that. According to IFA.com, where they have all these returns up there all the time, according to them, if you go back 98 years and 3 months, which I don't know how they do in emerging markets because I don't know how they find those numbers, but they do apparently.
Somebody does. They're recreating
and they say the return there is 12.8% annualized, which is far more than U.S. markets.
Isn't that interesting, though, that it's slightly less than what we previously talked about over that same period with small cap value, U.S. small cap value?
Exactly.
But it's another asset class, and the reason you own it is because you want to add those more aggressive asset classes to help boost your yield, but you want to diversify the heck out of the portfolio so that they don't always move at the same time, and therefore the volatility is not as high. The bumps don't feel as violent.
You're getting exposure to potentially faster growth at more ups and downs, right? I mean, you can remember the Asian crisis of 1997 and the market panic in Russia in 98, all these things. And the swings are far greater in these places, right? Because it's riskier. But you do get the diversification, Don. That's exactly it. You do get alternative currencies that you're investing in, right? Exposure to companies that you don't get if you just own the U.S. or even developed markets for that matter. Mm-hmm. So this is an incredibly important asset. I guess the bottom line for me is most of the time when we do a portfolio review, and we do these, you talk about them, where we take all of the stuff you hold, we show you how diversified you are, how much risk you're taking, how much you're paying others, all that stuff. People love it. But I would say 9 out of 10 times, maybe even higher, maybe 95%, people have very, very, very little exposure to emerging markets. That's backwards. You should have plenty of exposure to these things that have high growth potential. Are they riskier? Yes. Did they feel really bad when things go? Yeah, absolutely. But you don't put all your eggs in that basket. You put a good number of them so you're exposed to that potential. Growing middle class, companies that have tremendous growth potential. And you want to have some of your money. So this is a reason when you're doing your asset allocation to be so careful. It sounds so easy. I bought the S&P 500, but you're missing a lot of companies, certainly in the United States, but you're missing massive, not just developed countries, but developing countries.
Yeah, but I want to temper your enthusiasm a little bit because you basically said critically important part. It's just, we throw out a lot of critically important parts of portfolios. You need small cap, you need value, you need international, you need small international, you need real estate, you need emerging markets. You need a lot of these things. But to build a portfolio with all of these pieces and parts can be a lot of work. And then managing it, even more work. So if this is the kind of thing you're doing on your own, this is why we bore you to tears by saying just buy AVGE, the Avantis Global Equity Fund, or just buy DFAW, the Dimensional All World Markets Fund, because within those funds, they have already proportioned the assets between large and small and value and growth and developed and emerging and U.S. and international markets. They're doing it for you so that you don't have to. This is why our push towards these kinds of all-encompassing products, because I can tell you it's unlikely you're going to build your own and do it well.
I was just going to look up out of curiosity what percentage of AVGE is in emerging markets, because I'd be curious to know how much exposure they put. And they do oftentimes have a U.S. bias as well.
They have a U.S. bias. They do have a slight, and they admit they have a U.S. bias. They say the reason they have a U.S. bias is because you guys want it. Look at AVGE is almost 10% of the portfolio in emerging markets. So good for them both. Yeah. The core, and by the way, a 10% number is good.
Yep.
That's a very good number. So
you're getting a good exposure there.
And so why go to all the trouble of trying to build this portfolio when you can do it on your own? I mean, with just one portfolio, like the Avantis thing. So. Anyway, another topic we haven't covered in a while, something to bear in mind. And if you have something you want to ask us, we want to give you the opportunity to do that. And you can call us at 855-935-TALK and leave your question, or you can go online to talkingrealmoney.com and type your question or record your question. If you record those questions at talkingrealmoney.com, they become part of the Friday Q&A podcast that I do. Otherwise, Tom or I will get back to some of you and talk to you on the phone like this.
Chad calls us from Alexandria, Virginia. I think I have this right, too. I believe the high school in Alexandria is where they based the story. The story came from the movie Remember the Titans, which, good Lord, was 20-something years ago. I think I have that. Is that right? Do you know that, Chad, or not?
I don't know. I just moved here like 7 years ago.
Okay, so you're off the hook for that piece of local trivia then. That just, for some reason, it comes to mind. My mom grew up in Washington, D.C., so I know the area a little bit, but I wouldn't pretend to know it very well. But that was one thing that I thought I knew. At any rate, it's not about me, as I'm told regularly at home and on the show. It's about you, Chad. How can we help you today?
So I had a question about international equities, but I got a little small story before we begin, if you don't mind.
Absolutely.
But anyway, so I wrote my question right on Talking Real Money, and it was selected. And I was like, "Hey," I told my wife I was going to be on this podcast, and she's like, "Oh, that's great. What kind of question are you going to ask on this podcast?" And I was like, "Well, it's a financial question, and it's about international equities." And she said, "Why are you asking that question?" And I said,
"Why not?" Would be my answer, but okay.
I said, "Because we own international equities." And she's like, "We do?" And then I'm like, "Yeah, we have 15% of our money in international equities." And she's like, "Well, what stocks do we own?" I'm like, "I don't know." So I was like, I went to the fund, AVGE, and I kind of drilled down into the funds of funds, I guess.
Yes, correct. They hold their other exchange. That's the Avantis Global Equity Fund, and they hold other funds that hold those international stocks. That's correct.
Yep. So I looked at those stocks, and I'm like, so I told her, and she's like, "Well, what's your question?" I was like, "Well, it's about currency exchange rates. Is that a risk that we should be monitoring, or should we, I don't know, calculate that into, how much international stocks we own?" So anyway, that's my question. What is currency exchange risk, and should we take this into our, overall investment strategy?
The short answer is, the good news is no. The better answer is, the fact is, the people that are running the money for you at Avantis, they do consider that. And I'll give you an example, by the way. In the last basic year, the United States dollar is down about 2.3% compared to global other currencies it's compared against. This is just a broad average. So it's gone down a little bit, right? But that's a pretty mild change in a year and a few months. In emerging markets, for example, you get places like Argentina that can have wild swings, right? When you have massive inflation or they have some other, sort of economic calamity. So emerging markets can have a lot of impact. The good news is, again, the people that are handling that money for you at Avantis are paying attention to this. And also the other good news is, in a general way, those currencies kind of work their way out. In other words, it's a diversifier. It's another way to sort of not just be focused on one marketplace. And by the way, your wife, I think, correctly asked, why are we owning those? Well, let me give you another example. In Japan, it turns out that people have about 90% of their money invested in Japan. Wouldn't surprise you, right? But going back 1990 through, I think it was the end of 2024, Japanese investors basically broke even. The Nikkei didn't make any money in that whole period of time. This is why we believe in international diversification. I don't know how old you are, but I'm old enough to remember 1990, and I'm old enough to remember how the Japanese were dominating sort of the business world, if you would. They were telling us how to manage our companies. They were here buying all kinds of things, including famous golf courses and the like. It was all about Japan. And it turned out that no, the next 30 plus years were not. This is why we want to be diversified in all these other economies. and currencies. So the real way to be invested is to actually buy companies that operate in these other marketplaces, because then you're getting currency exposure, you're getting exposure to other companies that you just don't get if you only own the U.S. So back to your original question. No, this is nothing for you to worry about. You should be invested internationally, and worrying kind of day to day or even week to week or even month to month, frankly, year to year about currencies is just not something you need to pay attention to.
Yeah, that's what I thought. I think I was just overthinking things, and I'm a long-term investor, so I know I'm in this for the long game. And like you said, I kind of want to be diversified, but I want to be able to manage some of those risks the best I can. So
yeah,
that answers my question.
Yeah, no, the bigger issue, of course, is always stock to bond ratio. Then the next issue would be properly diversified in equities. The fact that you're using a very fine exchange traded fund, AVGE, is well diversified in equities. It has a tilt, if you will, to owning more small, more value. There's some other factors, profitability, quality, those things in there. That is really an outstanding portfolio for the long haul, and one that I think you can rely on well into your future.
Yeah. Hey, so when I started first investing back in the early 90s or late 90s, when I bought U.S. companies, it was kind of like a U.S. market. But now that these companies are, worldwide, right? So Apple, whatever, McDonald's,
Microsoft, sure.
Exactly.
Yep, NVIDIA.
So could the argument be made that if I own Microsoft or if I own this AVGE and is Microsoft considered a U.S. company, but it's international?
Yeah, they do sell a lot of products overseas. It's a great question. Study done by Dimensional Funds a number of years ago found that the answer to that is no, for the following reason. You really want exposure to those local economies. And the only way to get exposure to those local economies is to own the companies that operate in those places. While Microsoft sells, I forget what percentage of its software overseas, great companies, of course, are international in nature, but they don't get the specific exposure, if you will, to that local economy, the currency, the kind of the growth,
taxes,
all that stuff.
Okay.
And you really want to make sure you're doing that because it's a great diversifier. So, yeah, on one hand, it feels like, well, yeah, I own international firms. On the other hand, you really want to be exposed to those local areas to get the growth, the potential there, and to kind of get the leveling out of ups and downs of global markets.
Okay. All right. My only follow-up question is, a few years ago, I started listening to you guys, Don and Tom, are Talking Real Money. And when I first started listening on the podcast, Don was on the road, like in his RV. Is he ever going to get back in that thing and go cross country again?
I don't know. I think it's stuck along the roadside in Virginia somewhere. You may want to go look it up. The short answer to that is probably not. I invite him, of course, every summer to come and stay at our place, where he can park it and hang out. But I don't know that he's going to actually pull that around. I think you should send another question and say, Don, I want to talk to you about your next road trip, and see what he says.
Okay. Is it a tree question, or should I talk it into the mic?
You should talk it into the mic because he'll absolutely love that, Chad. It'd be fabulous. Right. Oh, great questions all, and thank you for being part of Talking Real Money.
Yes. Thank you. I appreciate it.
And Tom really loves doing those calls. He does. He has more fun with those. He has almost as much fun with those as he does printing up your questions that you send in at talkingrealmoney.com that get printed on pieces of paper. And for some reason, that makes him very happy. He likes crumpling them up between his fingers and making, old radio host noises from the past.
Let's not say old.
Well, he's dead, the guy I was thinking of.
I know who you're thinking of.
Yeah, you know who I'm thinking of.
Yes, I do.
Because he used to always do that.
He did always do
paper
that.
noise.
Yeah.
Do you have paper in front of you?
I do. I have paper.
Would you like to read us a question?
I'd love to read a question. Thank you for asking me. So kind of you. I really appreciate it.
I'm glad we have you for reading those questions.
Keeps me employed and hot on the streets. From Parker, Colorado. I don't know Parker. Do you know Parker?
Parker is southeast of Denver slightly, between Denver and Colorado Springs, closer to Denver.
Peter writes us, I have a small Fidelity account of about $17,000 that's in 12 stocks. I earmark $500 a month and try and decide what I should invest in. I'm 75. It's not part of my retirement per se. It's just extra money I'm playing with. I would like to see it grow over time, looking at a 5 to 7 year plan. I have 13 stocks. I'm going to give you a couple of them.
Okay.
I don't know these. I didn't look them up prior to the discussion.
Okay.
USB. Don't they make a cord that plugs into your computer or something?
No, that's U.S. Bank Corp.
Oh, U.S. Bank Corp. Okay, I should know that one.
Yeah.
BIZD.
BIZD?
BIZD.
That's a Van Eck income ETF.
Says a stock. Weird.
Well, it's an ETF. BIZD, did you say?
He says 13 stocks.
Did you say BIZD?
BIZD.
Well,
Yes.
he's considering it a stock because he buys it like a stock.
Okay. FLOT.
And by the way, ready for the expense ratio on that one?
How much?
I don't think I've ever seen one this high. I truly...
No, remember the one time we saw the one with 20. So it was hard to
Okay, was
top
that an ETF?
No, that was a mutual fund.
That was a mutual. This is an ETF, dude. This is an ETF, and 20% of the portfolio is in cash, and they do all kinds of 13%.
Good work if you're the manager, I guess.
Sell that one, sir.
FLOT. I'm assuming this is a boating company, maybe the one that constructed the Titanic.
No.
Oh, okay.
That's an iShares floating rate bond fund. So he's buying ETFs.
Okay, one more because I get the pattern here.
Yeah.
L, V as in victory, H as in happy, D as in dawn.
He's been watching
LVHD.
CNBC.
Yeah.
He has, because this is the Franklin U.S. Low Volatility High Dividend Index ETF.
Oh, Peter.
What's with the complexity?
I don't know. And
Because he's been watching CNBC. These sound like the kinds of things where they interview the manager on CNBC.
they got to fill the time somehow.
It strikes me that's where these are coming from. Or Fox
and then he adds, like you say, nothing fancy, just basic investment. What would you suggest I invest in each month at $500 a month? I think we just mentioned one fund that owns all of these various.
Well, but you see, here's an interesting little thing. He's got these income things. So he's saying on one hand, this is play money, but on the other hand, he's saying, I want low volatility. So I don't know what I am. I truly don't know. I hate to recommend or suggest anything to this person. I truly do, because this is such a mess. It's truly a mess. And he says he has 13 of these?
That's what he says. I didn't read them all to you because only so much
please,
pain
no.
I can take.
Just read me more.
No. Okay, one more.
Oh,
N
I'm having too much
as
fun.
in Nancy.
Hold on,
L
I gotta
as
get
in
back to
Larry.
Morningstar.
Y
Hold
as
on.
in year. NLY.
NLY?
NLY. Why
NL
not? I guess.
Are you
That's the
saying
question.
NLY?
That's what I'm saying.
Oh, Annaly Capital Management. What are they? I don't even know what they are. Apparently, that's a stock. Yeah, it's a stock. Don't know anything about them.
Yeah, this is
It's
okay.
it's a mortgage REIT. I just found them. Okay, see, just what did I say? This is a mess. This is just a bunch of random ideas that somebody got watching TV. I swear.
We'll have to wait. No doubt he'll write us back after hearing this and saying, no, you completely misunderstood my strategy here.
Oh, no, there is no strategy. This is a zero strategy portfolio. I'm sorry. There is no discernible strategy. There's nothing here that fits with, that song, one of these things is not like the other? Well, all of these things are not like the other. They don't make sense. The only thing that they have in common is that they sound like somebody's hot idea. Or
if you're going to have a hot idea, why not have like the BWET where you're betting on the futures of the tankers in the Gulf, right? I mean,
I thought we were doing a Bitcoin thing. Yeah, no.
Oh, please.
That was, ladies and gentlemen, please do not take Tom seriously.
I am serious. If you're going to buy the hot thing, that has been the best performing ETF year to date until recently.
Okay. Well, and these aren't hot. They're just funky.
Yeah.
I would unload this whole thing and maybe just put my $17,000 in a nice 7-year target date fund. Do 2035. There you go. Bing! Done.
Because you'll be 82 by then.
Yeah.
So,
yeah.
bing, done.
Well, because basically said about a 5 to 7 year time frame, right?
Yeah.
Did you say that? So that would be the 2035 target date fund.
I want to add one thing here. Mm-hmm. He used the word play.
Mm-hmm. But none of this is play.
Yeah,
if it's play, then AVGE.
Yeah, and this gets back, though, to purpose. We don't spend enough. We spend some time on this. Don and I have no play money. Well, unless we're playing Monopoly.
That doesn't look real.
Yeah, we don't have anything where we're like, I'm going to try to hit 1,000. We don't buy that because your money is your money, and one day maybe somebody else's money. Why would you play with any of it? Why would you think, well, I'm hoping to hit a home run when the likelihood is you won't? Part two is this is such a hodgepodgery that we can't even classify it as a portfolio. So no, we don't mess around with stuff like this. We don't buy individual stocks, all those kind of things that we spend a good deal of time talking about.
Yeah, and when you have $17,000 and you're putting $500 in, it's just going to keep making the mess worse. It's just going to get worse. This is just not. It's not a portfolio. It's a bunch of strange ideas. That's all. That's all I got. That's all I got for you. I think that's all we've got for the show, isn't it?
I think that's about it. Pull the plug.
We should probably put this one away. We'll put this one down. Time to put the show down. Hey, thanks for being here. We really appreciate you. Oh, and by the way, we have made the strategic decision. We have a strategy for this podcast. We are going to continue to do the thing that podcasts have done so well, and that is be audio only. I read an article today, recently in the last couple of weeks in the Wall Street Journal, about podcast listeners starting to get upset because their favorite podcasts are now, because it's all the rage, becoming video podcasts, and they're listening to them in their car, and people are referring to images.
And then driving into a tree.
And then, no, they're referring to images, and they just don't like the podcast because they don't know what. Anyway, we're going to be a good old-fashioned audio podcast. Well, we believe in the power of audio.
We had one of our former partners suggest that we do this all in video. We did for a while, and nobody watched, so it didn't work, to be fair.
Yeah, well, and they're still there, those old video ones, but no one's watched. The audio, we get a lot of listeners. We're tracking at well over 2 million downloads a year now.
And they're not all my mom because she's been gone for a long time.
So keep listening. Keep telling people to listen. Thank you so much for that. And if you have questions, go to talkingrealmoney.com. Click the button that says Ask a Question. Call us at 855-935-TALK. And if you have one of these messy portfolios,
like that,
like the guy in Parker, here's what you probably ought to do is sit down with one of our fiduciary advisors and let them tell you what's wrong and how you could probably do it better, and you're not going to be charged anything, and you're not going to get a high-pressure sales pitch. Tom and I absolutely promise. Cross our heart. Okay? Are we good now?
I think we're very good.
All right.
I think that was exceptional.
Here's what's going to happen. In a day or two, or maybe if there's a weekend in there, 3 days, we're going to be right back here doing this thing we do, which, we call Talking Real Money.
The opinions and views expressed on this podcast were current on the date recorded.
Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone.
This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction.
Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Apella Wealth, a fee-only registered investment advisor.
Please see Apella Wealth's ADV Part 2A on our website for information regarding Apella's fees and services.
Apella Capital, LLC, DBA Apella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Apella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.